So, welcome everybody here to the Alternative Investing Club. We are a club that focuses on how to invest passively when you are an active earner, whether you have a job at usually at a high-tech company, since we started off at Intel. But I know quite a few of you have migrated to other locations as well. And please, if you are at Intel, I would love to have your personal email address that I can send out invitations to. I've got a lot of Intel email addresses, and I'm not terribly comfortable with that because all it would take is Intel, blocking my email, and then I'd never be able to contact you. So if you have a personal one, send it my way, and I'll put it into the mailing list. If you want to receive it at Intel, that's fine too. Um, but today we have Jeremy Roll from the Roll Investment Group. I met you in person, I guess, back at the LFI conference, the Left Field Investors Conference, which was that a year ago now?
I've been to a couple of them. So it was either 1 or 2 or 3 years ago. I honestly have lost track of when those were.
Yeah, yeah. Well, this was the one that was actually at the baseball stadium in Columbus, Ohio.
Okay, so I feel like I feel like it was 2 years ago, but maybe it was a year ago.
Yeah. Okay. Well, Jeremy is a very well-known passive-only investor. He has quite a large following and does, I don't know if you would say advisement, but maybe I'll let you explain exactly what you do. Anyway, he's a well-respected passive investor. He's featured in a lot of different conferences as a speaker, and we are glad to have you here, Jeremy, at the Alternative Investing Club.
Yeah, thanks for having me, everybody. I'm happy to be here. Hopefully, just be helpful, and looking forward to your questions as well.
All right. With that, I think we'll simply kick it off, Jeremy. Let's start off, and I know you don't have a presentation, so today is going to be a little different than most. We're just going to have a dialogue. And the topic is, and I encourage everybody here in the audience to feel free to participate as well. Why don't you raise your hand this time rather than putting it inside the chat? You can, of course, use the chat to send questions, but if you want to actually speak, go ahead and raise your hand, and we'll call on you and let Jeremy take your question. Jeremy, can we start off with just you giving us a little bit of your background and how long you've been doing this and what exactly it is that you do?
Yeah, sure. Absolutely. Thanks again for everyone for joining us. I love, by the way, I'm not just saying this, but I've used many Intel laptops. So thank you for everybody's work over there. I don't know who works in that division specifically, but seriously, you guys have really helped to change the world. And kind of like you and Microsoft together, it's amazing what you guys have done to revolutionize, working. So it's crazy. Anyway, thank you. So my name's Jeremy Roll. I am a full-time passive cash flow investor. So full-time limited partner investor. I am not a financial advisor, investment advisor, accountant, attorney, or anything else. Anything on this live stream that we're talking about is just my perspective as an investor. I started investing passively in group opportunities where they pull a lot of people together called syndications back in 2002 in real estate. And essentially, at the time, I was working at Disney headquarters in Los Angeles. And I basically was sick and tired of the stock market because of the lack of predictability and the volatility after the dot-com crash. But more important to me was the lack of predictability, frankly, for my retirement account, like 10, 20, 30 years out. I just didn't know where that was going to end up. And so I started to look at different ways to invest, kind of came across the concept of cash flow. And ever since then, I focused on more predictable cash flow. So I'm kind of focused on the lower risk spectrum of these types of opportunities where they're buying a stabilized opportunity. Most of it's real estate, not all of it, but I'm all focused on cash flow and more predictable cash flow if possible. So I rotated all my stocks and bonds from the stock market and everything into cash flow between 2002 and 2007. And in 2007, I was actually working at Toyota headquarters in Los Angeles. And I had a last hour moment with a manager in a new division, which maybe some of you could relate to. And I decided to leave because I had enough cash flow built up to live off of. It was not my plan or my goal to actually get out of the corporate world from the cash flow. I wanted the paycheck and the cash flow. The cash flow just meant to be more predictable for my retirement account, but I ended up just taking that risk. So I've been a full-time passive cash flow investor since 2007. So it's about 17 years, a couple of months ago. But I've been doing it since 2002. So, 22 years. What else can I tell you? So just to touch upon what Daniel had mentioned, I'm not an advisor. I don't really consult or advise any investors. Happy to have one-on-one calls if it's helpful for you guys, but I don't I'm not hired as a consultant or anything. Honestly, I'm just focused full-time on passive investing for myself. And I do have an investor group. I don't normally like talking about it in public just because I kind of try to avoid public solicitation, but I essentially send a small subset of what I'm investing into my group personally, and then people can just invest directly with the sponsor under the exact same terms as me. I'm not an intermediary like pretty much all other investor groups. I've never pulled anybody into an LLC. I don't pull people together. Never even formed an LLC in my life. But so my primary focus is just investing for myself, trying to find opportunities full time. And also just by a little bit more background, I'm from Canada, from Montreal, grew up there, currently live in right next to Newport Beach in California. Had been in Los Angeles for about 20 years until a couple of years ago. I have an MBA from the Wharton School from University of Pennsylvania. And I spent over 10 years in the corporate world before I ended up getting out from the cash flow.
All right. Well, let me start off with a few questions then. When you were transitioning away from your job in Toyota and you found yourself becoming a full-time passive investor, what was that transition like? Was there a period where you had trouble supporting yourself, or were you able to do that right from the get-go?
Yeah. So I'm a really low risk guy. And so one of the critical things for me, especially when I did this in June of 2007, I actually anticipated a recession. Yeah, that's what I thought was the highest probability scenario coming up. And also my wife was pregnant and she was going to leave her job once we had our baby, which was in October. And so the cash flow coverage was absolutely critical for me. So I had a 2-to-1 cash flow coverage, meaning that if I needed a dollar to live off of, I actually had $2 coming in case that $2 ended up being $1.50 or $1.25 because of a recession and some things maybe slow down or stop. And my rule is that to me, and this is just completely subjective. So, but my really high comfort level is 3-to-1. Like that was always my goal, which I've now, which I hit a while ago, which was 3 times cash flow coverage to cost of living. And then you're at a point where like you can lose 2/3 of your cash flow sources and you're still okay, which is, when you're really diversified and you're investing all in different things in real estate and non-real estate all across the country, and you're kind of going lower risk, more stabilized type stuff, the odds of you losing, let's say 3/4 of your cash flow is low as long as you're really, really well diversified.
What do you do with that extra cash flow? Do you turn around and invest that in other deals, or do you put it away in a rainy day fund, or what do you tend to do with it?
No, you got to redeploy it because between inflation and the power of compounding, everything else that's surrounding that, it's critical to redeploy it. Now, I'm not hell bent. Like I'll sit on it if I have to. If I'm not finding the right deal, I'm not like hell bent on deploying. I'm not one of those people, and that's also subjective. Some people feel like they've got to get it out right away, and frankly, they're probably right from a mathematical perspective. At the same time, the key to being a full-time passive cash flow investor is low overhead. So you got to watch your expenses, but you also want to build your snowball because this is a kind of a get rich slow game. It takes a long time. But if you have the ability to kind of delay gratification and think very long term, I'm very lucky because I've been in this 22 years and good things happen over very long periods of time when you're reinvesting. And so that's basically what I've experienced. I will also tell you that another key thing that I think that I did is that once I had a core foundation of a really solid cash flow across a lot of things that I was very comfortable with, which frankly took about 10 years that I was really, really comfortable with it, I started deploying into a little bit of higher risk stuff. And I'm talking about even like startups, for example. And when I did that, I didn't say, okay, I'm going to invest in a startup, for those of you familiar with them, in like a series C or D and maybe get a 2 or 3 or 5X when it goes public. I was like, I'm only getting in at the beginning, the first round, a seed or pre-seed or whatever they call it. And, if I can't swing for the fences and think this could do 100X plus, I'm not going to bother because I can get the cash flow. And adding that into the mix really helped take me personally to the next level on a couple of things that I got lucky with. But I do think that at some point that's maybe a good idea as well. It all depends on what situation. If you come in with 10 or 20 or $30 million, that's unnecessary. But when you don't start like that, building the snowball just takes a very long time. So you can do certain things to make it quicker. One more thing, and I'm sorry, I know I'm going off on tangents, but just some learnings I'm realizing right now. I like investing in what I call some fully amortized opportunities as well. And they're much harder to find. But a fully amortized opportunity is when you're actually getting your interest and principal back together, so to speak, almost like you're the bank and so, you're paying a mortgage and you're paying interest and principal. So you're actually getting not just interest back, but much more in terms of a cash on cash return each year. And so there are certain things you can invest in, although they're hard to find, that helps to supercharge your cash flow. And that's what I did very early on. The way that I got to that 2-to-1 cash flow coverage when I left the corporate world, I was quite heavy on the fully amortized stuff, but there's risk to that because if you live off of it, when you're, and you're not reinvesting all of it, you start to like actually eat into the principal because you're getting interest and principal back at the same time. So I eventually, over about 5 years after I got out of the corporate world, slowly diversified much more heavily into non-amortized versus fully amortized. So I wasn't eating into the principal when I was spending money. But that is one way to supercharge your cash flow if you want to figure out how to kind of increase the pace of it, by looking for those, although they're hard to find.
All right, Anita's got her hands raised. Anita? And if you want to ask a question and take yourself off mute, feel free to hit the hands raised button.
Hey, Daniel. Hi, Jeremy. Thanks for coming in today. I have so many questions for you, but I'll try to limit them. So my first question is, how do you, like, when a deal goes bad, how do you ever choose to exit that deal and just take the loss? And then also, how do you handle cash calls? And then I'll ask the next one after you finish.
Okay. So, and again, keep in mind, I'm not a financial advisor, and this is just my own perspective as an investor, right? So, as far as taking a loss on something, so that's always a possibility, but just understand that one of the downsides to investing in these kind of private opportunities is that they're highly illiquid, right? So you can't go on to like your stock screen on Fidelity and press sell and get your money in 1 to 3 days. That's not at all realistic. In fact, I believe it's illegal to resell your shares within the first year per the SEC in anything private that you invest in, and in the typical structure. And then after that, the challenge is that no one, let's say you invest in a 200 unit apartment building near where you live. You may think you know what it's worth, but without an appraisal, some other random investor isn't going to trust you, but they're not going to pay for an appraisal. So when someone's buying your shares, you actually have no current value. It's not like you're going on, Intel stock is worth 26.42 right at the second, and that's a market fact, right? And so one of the challenges is you're typically selling at a discount. And when you're in a distressed situation, you're selling at a major discount or possibly not finding anyone to buy to take your position unless it's at a ridiculous discount. So you have to keep in mind that if you do want to sell, it may not be possible to find a buyer, and the pricing is probably not going to be favorable in the best of times, right? Because someone else is taking the risk on what they're buying without all the information. So that is a possibility. And honestly, sometimes it makes sense to do that, to take a loss. Like I actually personally purchased someone's position in an opportunity in the last 4 weeks who it was an opportunity that's been cash flowing lower than was projected. It's been going on for about 9 years. They're just kind of done with it. And they wanted to just take the loss on their books for their own company prior to the end of August. It was beneficial to them in this particular year. So I bought it at a very steep discount. And I frankly, I didn't even want to buy it. It was a friend of mine. I just was trying to help them. I did them a favor. But that does happen. Just beware that it can be very hard to find someone to buy your shares, and it may not be possible to find anybody. So the answer to your next question with a cash call is you're asking, how do you know whether to participate in this cash call? Was that the question?
Yeah. How do you handle them? Like, do you actually say you're going to give them money, or do you just say you guys are on your own?
Yeah. So cash call, for those of you who are not familiar, it is possible that despite the original investment that you made, that an opportunity may need funds sometime in the way through of its life. And there's a lot of different examples of this. So there's cash calls for bad reasons, and there's cash calls for good reasons. So an example of a cash call for a bad reason is something's in distress, and without additional cash, it's going to get foreclosed. Then you have to kind of look at all the numbers and decide for yourself based on the projections you've been given by the manager, which you may not agree with or may agree with. Does it make sense for you to put more money into this already beyond what you've already put in, right? And that's, to me, most of the time, it's a combination of a mathematical equation. And do I still want to make a bet on this person? Do I actually think this person's going to execute given the way this has gone so far? Because where in distress, there could be distress for many reasons, some of which could be the result of managers' actions, and some of which just could be the result of market forces, right? So you have to assess all that. A good reason for a cash call, which you don't hear about as often, but I've been through many times, is, and this is actually common, this has happened to me a number of times, is let's say I'm invested in a retail strip center. And this is actually a real example. I'm in a single story office building that was an indoor mall in Canada that was converted into a big office building. The Canadian government, because they manage all the medical up there, took the entire building and just put a whole bunch of medical offices in it that consumers come into, and they keep expanding it. And every time they expand it, we don't have the cash to build it out in what is called tenant improvements, where you're sharing the cost with them to build it out up front. That's a common thing. And so they will turn to the investors and say, hey, you have to, hand us X amount of dollars. But by the way, here's the projections of what you're going to make off of it, because money is being used to rebuild or to add on to this building and even construct onto the building, but the government's going to give us a 20-year lease, and here's what you're going to make from it, and here's why we think it's a good idea. Here's a business plan. And those can be some good reasons. Again, you have to go assess your opinion about the cash flow. Is that the best use of money? Do you even have the funds at the time or not? So there's cash calls for often reasons. And so Anita, it's tough for me to give you any feedback without looking at a specific scenario, because a lot of it has to do with the numbers.
Okay, thank you very much. My last question is, what has been some of the better real estate sectors that you've invested in passively, or are there any?
Yeah. So on the real estate side, so you have to understand there's 1,000 ways to invest. None of them are wrong. And I just have my own opinion about what to do for myself. But it's frankly, I think it comes down to people's preferences and personality, what the best fit is for you in terms of your personality and your goals. So I target low risk, more predictable cash flow. And I target stuff that's 80 to 100% occupied, stabilized in non-volatile markets, meaning just very slow and steady markets, not trying to get any crazy gains in value of the property itself, just trying to get more predictable cash flow with hopefully population growth in that area and a lot of good employment and jobs. And so for me, the ultimate investment is one that's going to cash flow very predictably for a long time, right? Because that's my number one thing is I live off the cash flow. I want to go to sleep tonight, wake up tomorrow, and not much has changed because I live off the cash flow. So with that in mind, my number one choice is probably mobile home parks. Now, mobile home parks have come a long way since I started investing in them in 2009. And what I mean by that is that they've become much more mainstream, which has also driven up their prices substantially, which also means that the level of cash flows you earn from them is substantially lower than when I started, which is unfortunate for someone who started a long time ago, but it is what it is. But the reason why I mentioned mobile home parks is because unlike apartments that typically have, depending on the location, I'm just going to give you a random average, about 50% turnover in tenants every year, right? Mobile home parks have about an average of about 9% turnover every year. And what does that mean? That means that is much more stable and predictable than an apartment building, right? Even though apartment buildings are still a great source of cash flow and very high demand in most markets. So that's my number one choice, probably on average. And there's pros and cons to every asset class. I'm just giving you a generic, high-level answer. My number two choice would probably be apartments. And that's for multiple reasons, not the least of which is someone's always going to meet, people always need a place to live. And with houses being as expensive as they are today, I believe that demand is very high for apartments now. And I kind of see that for the foreseeable future, only because my own opinion, which could be wrong, is that house prices are probably going to go sideways for a few years so that they become more affordable. I don't think they're necessarily going to go down that much, although I prefer they do because I'm looking to buy a house. But I think they're going to go sideways for many reasons. And when they do, that affordability is going to take a while to catch up with salaries or wages going up. And during that time, people are probably not going to have much many people are going to have no other choice but to look at an apartment, right? So that's my number two choice. I also like self-storage a lot for predictability. People tend to stay in there as tenants for a long time as well. But that's a whole different animal because it's currently having some challenges at this particular timing. But for the next 10 years, if you ask me, what are you going to be your number one target asset classes for the next 10 years, assuming, even if we have a recession or not, which I believe there's a high probability of recession coming up, it would be mobile home parks, apartments, and self-storage in that order as my tier one, with everything else being tier two. Still possible options for me, but being tier two because I don't believe they're quite as predictable as those two or three.
Thank you.
All right, we've got a number of questions that are coming in both over the chat and through people raising their hands. And I would love to ask my own questions as well, but I'm going to go ahead and trade off between people in the chat and people raising hands. So in the chat, Kayleen is asking, if you were starting out now and leaving your corporate job, would you do anything differently?
You mean differently compared to what I started, I'm assuming, or what I did before?
I think that's the question.
Okay.
Or maybe we could rephrase it. What would you do now?
Yeah, good question. So here's the number one thing. It's so funny because we're in August of 2024, and I almost feel like we could be having the same conversation in August of 2007 when I left in June. And I left with the opinion that we were going to have a recession. I would be leaving with the exact same opinion. And knowing that, the thing that I would do now is be 100% sure that you have well-diversified, large enough portfolio of cash flow. And when I say diversification, my opinion of diversification is achieving it across asset classes, operators, and geographies, all three, okay? And so you should expect potentially your cash flow to be reduced going forward during a recession, some of it to possibly stop. And also you really need to assess am I in things that will perform well during a recession? Because some things perform better than others. So I'll give you guys quick examples. Office buildings, companies downsize. Now it depends who the tenant is. If it's full government, you may not have a problem. But if it's, imagine if you were, no offense, of course, but there's been a lot of tech layoffs in the past 12 months. I'm sure there's been some office reductions from tech, right? And so you really have to take a look, like in a strip mall, if you're in a strip mall that's anchored by a grocery store, that's probably not going to go anywhere, especially if it's a larger, well-known brand, right? And there's a lot of traffic there. But if there's a furniture store, those do not do well during recessions. On the other hand, if you're a gym, you're going to be fine. So you really have to look at what you've invested in, make sure you're comfortable that it's going to do well in a recession. And hopefully you have that cash flow coverage ratio we talked about to kind of mitigate that. So I just be really open eyes about the likelihood that you're going to have a lot of headwinds in the next 12 months from a probability perspective.
I was researching Tallahassee a couple of years ago, and one of the things I liked about them, and why it may not be the same now, but their top three industries were government employees, healthcare, and education. All three tend to do very well in a recession. And so, you have to look at your job diversification too, and figure out what's going to be resilient during a recession.
Yeah, and I agree. Sorry.
All right, let's go to, I believe William was next with his hand up.
Yes, Jeremy, as you get money coming in through your passive income, it's not taxed. What is your method for putting money aside for taxes?
Okay, so I think your question is, let's say you're getting quarterly distributions, but those aren't taxed. In other words, there's no withholding of any tax. And then you may have to pay that tax a year later when you file your tax returns. That's what you're saying, right?
Yes.
Okay. Yeah. Great question. So you do have to be aware of that. So unfortunately, when you get really well diversified, you honestly have a lot of balls up in the air and it becomes a little bit complicated. You get good at it over time. But essentially, here's the positive thing though. A lot of the opportunities I invest in are hard assets, and those hard assets have depreciation and expense flow through that come to me on the K1, which is the tax form that I receive. And this is actually one of the benefits of investing. I'm not here to sell anybody anything, just understand, but this is one of the benefits of investing in real estate, in that it's very common for me to invest in a property and to have the taxes deferred, meaning that I could receive $1,000 a year from that property, but my tax form says I actually have a loss from a tax perspective, a negative $100. And that actually goes towards helping my taxes because it's actually a loss that's offsetting other potential income or gains. And so depending on what you're investing in, you really need to be aware upfront of how much depreciation and expense flow through coverage you're going to have, and whether you may or may not have a tax bill from your passive income. If you do, you obviously have to budget for it and be very careful when you're reinvesting, but that's less of an issue when you're investing in certain types of opportunities like the typical real estate. Now, just note, every piece of real estate depreciates differently. Some managers can choose to accelerate depreciation through something called cost segregation, where you actually get more of it in year one, and then you may have to recapture or pay it back towards the end. So there's all these different scenarios. So if you're new, you should definitely research it. It's a really good point you brought up, just to be sure you understand what your tax situation might look like. Even before you get into it, most managers will be familiar enough with this to be able to give you an idea.
Just a quick flashback here. I know you mentioned mobile home parks. For those of you who are in the chat now, last week we had Pasha Esfandari come and talk to us about how to vet mobile home park operators, and that was last week's meeting. It's up at alternativeinvestingclub.com if you want to see it. So next, I'm going to go to Glenn on the chat, and he's asking, are you a bigger fan of debt side instruments or equity side in things that are permanent cash flows like triple net leases?
So by the way, before we get into that, just mentioning mobile home parks, I rarely recommend the course because I rarely take them because I'm always afraid there's just a sales pitch and then I'm just going to waste money. But let me tell you, I've invested with these guys. They don't currently have any open investments, but in my opinion, if you want to research mobile home parks, it's not cheap. It's probably $1,000 or $2,000, and it's designed to be for people who are buying mobile home parks actively. But Frank Rolfe, Rolfe, I think it's like Mobile Home University or something similar. Just make sure you Google his name. That course is fantastic. And because I was an investor in one of their funds way back, I was able to go to the course for free. I've been to it several times to refresh myself, so I'm very familiar with it. And it's hard to beat. They're one of the best known, they're actually the fifth largest owners of mobile home parks in the US, but they're private. And they've been in the business for decades, he and his partner. So anyway, just want to pass that along in case it's helpful to anybody. And he also has a great podcast too every week.
I was going to recommend a podcast for mobile home parks too. Kevin Bupp has a podcast for mobile home parks. He's been investing for a long time. His main podcast is Real Estate Investing for Cash Flow, but he also has one that's specifically for mobile home parks, and he really takes you through the whole thing. It's like 60 or 70 episodes.
Yeah, Kevin has been in the space for over a decade. And in fact, I met him at a conference, I think 9 years ago. And he, to your point, has probably hundreds of episodes on the podcast at this point. And he actually has an open fund. I'm not invested with him, but he does. I think he has an open fund right now, in fact. I'm not 100% sure. So I'm sorry, I got myself sidetracked. Can you ask that question again? I'm sorry.
Oh yeah, let me bring the question back up again. Oh, it was do you like debt funds, or do you tend to invest on the equity side in things that have more regular cash flow, like triple net leases?
Yeah, good question. So I typically don't invest in debt, and the reason why, and again, I'm just one person's opinion. Debt may be the perfect thing for you, but for me, because I target lower risk and more predictable cash flow, the thing I like about equity is that when I invest in equity, there's potential upside possibly, right? So because I'm already targeting lower risk, which often investing in debt, the purpose of it is to kind of reduce risk in many different instances, not always, but often. I don't want to fix myself to just having that fixed return when I'm already have the option of doing lower risk plus a potential upside. Now, we can talk about debt for a while because debt has all different aspects. You can do low risk, medium risk, high risk. There's many different things to consider with it as well. And as far as single tenant triple net deals go, I know that was just an example, but just you all know, I don't invest in single tenant triple net deals because I like having tenant diversification. Now, if there's a fund that has 50 different properties of single tenant triple net, that could work. And for those of you who are not familiar, single tenant triple net is essentially the idea of investing in a property that has one tenant in it, where the tenant is paying all of the taxes and maintenance and utilities, et cetera. That's what the triple net means. And it's the typical examples, like if you see a Starbucks or Taco Bell as a single tenant sitting there on that property, often, most of the time, they don't own that property. Someone else owns that property, has them as a tenant. And it's almost like clipping a bond or a coupon because they're just sending you a check to be there, but they're actually paying, there's no other expenses associated with it. For me, the lack of tenant diversification means that if someone leaves tomorrow and you have no tenant, that property can be foreclosed because you have nothing coming in, right? Whereas if I'm in an apartment building with 200 tenants and one tenant leaves, it's still going to be fine tomorrow morning. So that's why I don't invest in those typically, but they are a good fit for a lot of people.
All right, next we're going to go to the hands up, and I believe Eugenia was next.
Thanks, Jeremy. I want to get a sense of, do you have a minimum amount of free cash flow that you would meet your buy box? Or is there a ratio of capital to free cash flow that meets your buy box?
Yeah. So, and you're asking me, like, is there a minimum, for example, year one cash on cash flow target return where it's like just not enough cash flow for me? Is that what you mean?
Yeah. So I'm kind of wondering, I mean, if the borrowing rate is what it is, right? So being kind of on the higher side this time around, it seems like finding the ability for to get free cash flow is very, very tight, right? So unless you really do go really low on the cash flow on your buy box, it seems like it's a bit of a risk there, right?
Yeah. So if I'm understanding you correctly, so typically what I do is I set two different targets for myself for cash flow. Like look at a minimum year one projected cash flow net to investors and a certain minimum. Let's say I often invest in a 10-year deal with a fixed rate loan. So it's commonly like a 10-year projected return. Then I look for a 10-year average annualized cash flow projected net to investors. I look at both of those. For me, let's just talk about year one for a second, because typically year one's the lowest number and it goes up from there. Not always, but very often. And so personally, my comfort level is typically hitting 7 to 8% year one. But you have to understand that that is also within the parameters of very specific properties and locations that I target. So you can hit 7 to 8% in a very rough area because you have more risk. It doesn't mean that because of that is doing 7 or 8% year one, that's going to interest me at all, because that may not be the right fit for me. So, but for the type of stuff that I target, I'm looking at 7 to 8% year one, which right now is almost impossible to find unless it's very unique deals. because for a multitude of reasons, not the least of which is I don't believe we've had a recession yet. I think we will. I don't think we've had a full pricing reset yet, even though we've already had a pretty substantial price adjustment. And so I think that once prices come back to normality or normalize, I believe I'll be able to hit that range with a reasonable. That's another thing. Also, the loan term can dictate if you get 90% loan to value, like a huge loan, you might be able to get a higher return, but now you have more risk. So I typically look for conservative loans, still try to hit that type. There's a lot of different factors that go into like what then produces that projected cash flow return. And so that's important to keep in mind as well.
All right, going back over to people who have entered into the chat. Let's see, we have a question from, actually, I think there's a couple of people that said that you share a portfolio example. Maybe I missed when you said that, but are you able to share that?
A portfolio example.
Yeah, give some examples of the opportunities.
I think they may have been referring to like what a fully amortized opportunity example is.
Okay.
I hope, I don't know if I have that right or not, but should I just give that maybe?
Sure, yeah.
Okay, so you can get into something called notes, or you can buy notes, which are basically mortgages or loans or whatnot. And a lot of those notes are fully amortized, right? So someone could have a remaining term on a mortgage of 9 years, and they're paying principal and interest at the same time. And then you might buy that and actually take it. This could be a private note. Instead of someone getting a loan to buy a home from a bank, they got it from an individual. And you may then step in, buy that loan, and basically step into the position of what is equivalent to a bank and hold the note. And you're receiving those payments, and that note is actually secured against the property. Now, notes are tricky. There's all kinds of aspects, but you can be first position, second position, third position. There could be all different aspects to it. But that's one example of something that is fully amortized. There's certain businesses that can be more fully amortized. I've been investing in ATM machines since 2008 with different operators. And typically, you're getting a very high cash-on-cash return because of the fact that your machines are worth almost nothing at the end, unlike real estate, which kind of tends to hold or increase in value. And so you have to have a higher cash flow when you're investing in that type of thing because it's appreciating and your equipment is not worth much at the end. So there are different scenarios you might be able to find. Like I mentioned at the beginning, though, it is harder to find fully amortized scenarios. They won't be easy to find, honestly.
Hey, Jeremy, feel free to pass on this question if you want, but can you mention a couple of the ATM people that, or at least that are out there in the market? I've had this question a couple of times, and I'm usually only able to come up with one or two responses there because I don't tend to do that myself.
Yeah, honestly, I'd be very careful with ATM operators. When I first got in the space in 2008, I started investing with a very small operator. He unfortunately wound down his business, sold it off in 2023. So I went 15 years with him, and then that ended. ATM space is very tricky. If you look up ATMs, there's many Ponzi schemes because of the projected returns are very high. And so you have to do a lot of due diligence just to make sure you're not getting into one of those. And so you have to be careful with those. I don't have any recommendations at this very moment, honestly. It's very hard to find operators. A lot of the operators start small and just kind of reinvest themselves. And some of them are huge portfolios that resulted of large institutional investors coming in. So it's hard to get that middle ground. To be totally honest.
All right, going back over to people that have their hands raised, and if you want to ask a question here, feel free to put your hand up. Nadosium, what's your question?
Yes. Hi, Jeremy. I feel like I've lost all my questions, but I had so many because you were throwing a lot of terms that I did not, terms that I'm not familiar with. But I guess maybe simply, if somebody is not well versed, like your approach, which is low risk and just sort of consistent cash flow, I guess I'll just ask, do you do any sort of mentorship or courses or anything for somebody to sort of get like an idea or to gain insight into how to go about even knowing where to start and knowing how to or knowing what sort of avenues one can go about going after these consistent low risk investment? Pretty much like, I guess in a way, I guess I'm asking, how do I do what you've been able to do, or like, how can somebody younger, like illiterate, be able to sort of set off on going about doing what you've been able to do over the years?
Yeah, so good question. So let me tell you how I started, which is different now because it was a long time ago. So I started off, I lived in Los Angeles, and so I had the luck of being in a large city. And if you happen to be in this position, this might be possible for you as well, where there were a lot of monthly meetings that are out there for this type of thing. I used to go to 2 to 3 meetings a week. This is before I was married and had kids, and I had the time. And it was a lot of work, but you really learn a lot about going to these meetings. Some of them are now virtual. Where I found my meetings at that timing was on meetup.com, which you could still find meetings on today. There's probably other places you might be able to find them as well. That's one source I strongly recommend because, these days you can never have to go to a meeting in person and learn all the same thing. And actually, because you have access to the entire US through virtual meetings, you can be on multiple meetings in a night with that in your pajamas, not even moving from your chair, which is unbelievable, right? That was impossible for me. Another source that I'd recommend is looking up some podcasts. One benefit about podcasts is that you can learn about the different asset classes pretty well. You do have to watch out for the fact that a lot of the managers come on and they're there to sell. But if you look for some of the right podcasts, basically either limit selling or very specific and trying to get better or more experienced operators. And there's a lot of podcasts out there now. There's more than enough, frankly, and some of them have thousands of episodes. So you'll find a lot of really great content on the podcast just to kind of help you to get a little bit of education. You can also look at some books. Now, courses, I'm going to stop short of there because I get very weary of courses. And I apologize, guys, because I'm biased against sales pitches. So it's a very big thing for me. And so there are probably some really good courses out there. I just don't have a specific one to recommend. But I do have a couple of books I can recommend, for example, because I've read them myself, on apartment investing, if you want to take a look at that, which is a very common place for people to start. One of the reasons why that's a common place for people to start is because if you think about a city, in a typical city, there's many more apartment buildings than almost any other type of real estate, if not every other type of real estate. So it's easier to find opportunities because there's more properties out there. So if you're going to read up on apartments, there's 2 books I'd recommend if you want to learn how to analyze them. One would be by Brian Burke, Burke. I honestly don't remember the name of the book. I apologize, but if you go on
the
Amazon,
hands-off investor.
Okay, thank you. Hands-off investor. So I would recommend in this order. Actually, I'd read his first because it's more high level, and he's a manager. He's been buying apartments for many years. And the second one I'd recommend is by Rob Beardsley, Beardsley. I also don't remember the name of that one either. But you can find that on Amazon as well. That one gets into even more data analysis. One thing I'll caution you of is if you're going to go down this path, you have to be able to confidently analyze numbers and be willing to learn about how to analyze numbers. Because if you don't get to that level, you won't be able to really know exactly what you're investing in and have the confidence of knowing whether you're investing in something that with reasonable projections or conservative projections or not, which is key in this space. So I definitely do not recommend this for people who are afraid to look at a spreadsheet and don't want to look at numbers or crunch any numbers.
So that actually goes to a question that I wanted to ask you is that how big is your spreadsheet? Do you keep it all in one spreadsheet? Do you have multiple spreadsheets? Just kind of logistically, How do you do your number crunching?
Yeah, so let me just start by saying that there's now a number of pieces of software people have built. I don't use any of them, but there are, which is a much more modern and kind of up-to-date way of managing that, where you can actually pay a monthly or annual fee to get access to be able to put the basic information into software. Some of them even pull from bank accounts and look at your cash flow. I use Excel, old school. I have 2 spreadsheets. Well, I actually have 2 sheets and a workbook. One of them is my cash flow, and the other one is kind of net worth or I guess you can call it net worth or value of what I invested into my upfront investment to start. And so the second sheet is kind of more just, okay, what did I invest to start in this? Just so I have that tracked and I can kind of look at my total of what I invested across everything. The first sheet, the cash flow, is a more important one. And the way that I work is that when I first invest in something, so we get typically quarterly distributions, but they typically project annualized. So I have to take the annualized projections, divide them by 4, and just pretend that it's each quarter. And then I will go out 10 years on the spreadsheet by month, and I'll say, okay, when does this manager typically make the distributions? I'll ask them. And then I'll plug in the projected distribution I should be getting in that month that it should come every quarter for 10 years. And then you have then know when you're supposed to get a payment and what it should be. And then I compare that to what has actually come to me. And then if there's a variance of more than 20% up or down, meaning that either I got more than 20% too much or 20% or less too little, I'll make sure I understand why, or if not, I will talk to the sponsors like what's going on, just to understand what's going on. So that's how I work with my spreadsheet.
Yeah, I got to throw this recommendation out there too. I came across this, and this is actually more for your personal finances that rather than investment. But if you go to tillerhq.com, they have a tool which is basically just an Excel plugin or a Google Sheets plugin that connects you to Plaid, which is a banking service. And they have a great spreadsheet that will do all of your personal finances, and that plugin will pull data from your bank directly into your spreadsheet. I geek out on it because I don't like putting my personal stuff up on somebody else's webpage. This way, it's my own spreadsheet. So I'll throw the link in there. I've got no affiliation with them. I just like their product. And I think it's $70 a year if you want to use it. Let's see. We had a question actually, before we go to the question, you mentioned podcasts. I love podcasts. It's the primary way that I tend to learn things. What are your favorite podcasts in the investing area?
Honestly, it's gotten to the point. So the podcast, just so everybody knows, started, I think, from what I recall, around about 2015 is when they started to get really popular on the investing side in this part of the investing space. At this point, some of them literally, many of them have thousands of episodes. So it's hard for me to pinpoint a favorite. One that I really like, I'm biased because I'm friends with him, but one that I kind of like because one of the things you'll find is if you start searching on the podcast, you'll often find the same people across all of them. And honestly, I've been on over 200. And the reason is because I went on one, and then all of a sudden someone who manages a podcast sees me because they need content. And they just invite me, and I typically don't say no. And then the next thing you know, it's like everybody has invited me because they just seen me somewhere else, but honestly, for no better reason than that. And so if you want a podcast that's not like that, is kind of like finding unique people. I find Cash Flow Connections is very good. And actually, I was the first person ever on that podcast, just full disclosure, but I literally just recorded another episode of that randomly yesterday. I hadn't been on for like a couple of years, I think, or more. Yeah. What's that?
Oh, that's with Hunter Thompson?
Yeah, with Hunter. Yeah. And I just find that he gets speakers and perspectives and a lot of economic stuff that you just don't find on a typical podcast. But the other thing I'll recommend, though, is I like the larger podcasts just because then you have just more selection. It's almost like I like the larger conferences you can go to in person if you want to, for the same reason. And by the way, I skipped before that. And by the way, some of the larger podcasts you may want to take a look at is the Best Ever podcast, which is, I think, one of the biggest, if not the biggest. Cashflow Ninja is a very big one. But honestly, you'll have no problem finding that will be the least of your problems, is finding podcasts to listen to. You have to, I promise you that. Bigger Pockets actually just launched something called Passive Pockets, which is they bought Left Field Investors, which was an online kind of forum and investor community. And they're now launching their own passive investing site. So for those of you guys who are not familiar with Bigger Pockets, I think they were the largest kind of active investor community that exists in the US online. And they just are now starting to go into the passive side. They literally just announced this week officially, and they haven't even launched yet. So you can go into biggerpockets.com and you can actually register to be notified when Passive Pockets launches. I think that's going to be a very big community. I suspect they're going to have a big podcast as well, and that'll probably be worth listening to. Oh, one more thing. Yeah, one more thing. When we were talking before about different things I suggest on how to start, this is it's expensive and takes time, but if you have the ability and the time, the money to do it, I do recommend you consider to go to conferences. Two things that happen at conferences or in-person meetings in general is that you end up learning a lot because you're really focused, and you also end up networking, which is very key in this space. There's many different conferences you can go to. Some of them have multiple asset classes. Some are focused on like one asset class. One that I definitely recommend each year, because it's probably one of the biggest, if not the biggest one each year, is the Best Ever Conference, which is going to be in Salt Lake City. I know this because I'm going to be there next year, I think, as a panelist. I just spoke to Ben yesterday, who organizes the whole thing. He told me it was, I think, March 3rd through 5th of 2025. Don't quote me on that because I don't think it's even like officially. I probably shouldn't have mentioned that. But it will probably be in Salt Lake City again. There's just a lot you can learn, and just being amongst a lot of people is a really efficient way to do that as well. Sorry to interrupt you, Daniel.
Oh, that's fine. I was just going to give a shout out to Whitney Sewell and the Real Estate Syndication podcast. I learned a lot out there. Also, I got to tell you a funny story to pull together the Best Ever Conference and Hunter Thompson. My wife and I were at the Best Ever Conference in 2020. I got really sick and I ended up staying in the hotel room. My wife drove to the conference and picked somebody up on the side of the road that was walking there. Turns out it was Hunter Thompson. And
Seriously.
yeah, seriously. And she got back and she mentioned this to me, and I was like, "Oh, you got to meet Hunter Thompson?" So I was very jealous of her for that reason.
Oh, that is
But
funny.
I saw him at the booth later on. Um, okay, let's see. Going back to the typed questions, SS is asking, what is one opportunity or a few of them about things we are already familiar with day to day that are low risk and easy for novice investors?
So here's what I'll say. The one thing you need to be aware of is, let's say you go to a bunch of meetings, or let's say even better, you look at podcasts and then you see there's mobile home park, self-storage, retail strip center, retail enclosed mall, office, self-storage, industrial, notes, single family homes, hard money lending. There's all these things. There's a lot of stuff. Okay. I would strongly recommend focusing on one asset class to start, whatever you're most comfortable with. So I tell people, like, if you grew up in a mobile home park, start with mobile home parks. You will understand that better than anybody. You'll be at a very good starting position, and you'll have less to learn to be able to really figure that out. So a lot of people start with apartments because they can relate to them, they've lived in them, and they're also probably the easiest asset class to find opportunities in, right? So focus on one first, learn it really well. And I say this because once you learn how to analyze that one asset class, about 80 to 90% of that information is transferable to the next asset class, because there's still going to be revenues, there's still going to be expenses, there's still going to be multiples of how like they buy these buildings in terms of cash flow, there's still be loan, different parts of lending you have to understand about what the loan terms are, and all these other things, right? There's occupancy and all kinds of stuff, and it's similar across all of them. So, but do yourself a favor. I unfortunately have seen this before, where people get distracted by looking at trying to figure out which one's the right one. They're looking at 10 of them over the course of a year or two, and they don't know where to start, and they never end up starting. And so I definitely recommend starting with one once you figure out which that might be the best to fit is for you.
All right. Is there anybody else that would like to raise their hands and ask a question? Otherwise, I'll start asking my own. And just to let everyone know, we've got 8 minutes left in this meeting. Glenn.
Raising mine. Hey, Jeremy. So I threw in the chat. I think it probably scrolled up. Okay, so we're always getting pitch deals from somebody, and there's the sales pitch angle of this, which you've already said, you know, is something you avoid. There's the I don't know where to look problem of getting started and trying to find deals. And so, given you've been doing this for 20 years, you've probably built a lot of techniques about, you know, places to go and relationships to build and so forth. So have you got sort of your wisdom you'd want to impart on where and how you go deal hunting and not take pitch decks constantly?
Yeah, so I'm going to answer that a little more generically, I think, which is like, if you're starting and you don't quite know how to find opportunities, there's different paths you can go down, right? So you can either go and try to find the sponsors or the managers directly yourself, which involves a lot of networking, or you find someone on a podcast and you contact them, you seem to like them. That's one option. There's another option where, let's say you're really busy in the corporate world and you don't have time to find sponsors, or you don't even have the interest in putting the time in, but you're interested in going into the deals. Then there's kind of two obvious options on that side of things. There's crowdfunding websites like the Realty Moguls of the world. And in full disclosure, I have been in the past a advisor for Realty Mogul, but I know the founder very well, and I have a lot of respect for how they weed through their opportunities. So that's one option. And there's plenty of crowdfunding websites in real estate now you can go and find online. If you just Google real estate crowdfunding or real estate crowdfunding website. The other possibility is to invest through investor groups. And these groups typically will pull people together into their own entity, and they'll negotiate possibly better terms because there's a larger, critical mass of people. And you'll have someone who is theoretically vetting that opportunity. You need to vet it yourself, but then you have someone else who's already presenting it to you because they thought it was good. Now, the downside is that you're going through an intermediary. You're not going to talk directly to the manager. And you're also not going to get the same level of return because the intermediary is typically a business with employees, and they make money. They have to make money by being an intermediary. So they take a portion of the profits or a spread or some type of management fee in exchange for finding, vetting an opportunity and sending it to you. But it does make sense for some people to end up with a lower return in exchange for having someone send deals to them. So that's another option if you're very busy that can make sense for some people.
Is this where I plug the club fund that we have here? I'm just
Go
kidding.
for it. No,
No,
go
no,
for it.
I'm not going to.
Okay.
But I think that is a service that can be valuable. All right. SS is asking, actually, Kayleen is asking, and I'm gonna augment her question a little bit here. We've got 6 minutes left. She's asking about the role of AI moving forward as a passive investor, and I want to broaden that to AI. And what are you seeing in the current economy? Is there any cautionary tales or anything that you think will cause particular areas of the economy to pop? What's your feeling on the economy today? And then comment on AI.
Okay. Well, let me address AI real quick because I am the wrong person to give feedback to people on AI. I'm not on like the forefront of what's going on in AI. Honestly, I will spin the answer to like not on my mind right now as an investor is not how will AI impact me in a few years because I'm a little bit skeptical in terms of how much impact it's going to have in a short period and maybe in the long term. It's kind of like self-driving. I feel like I haven't seen that happen yet, so I'm waiting for AI to really impact me as well. And I could clearly be wrong. But more importantly, I would be thinking about if I'm investing in a type of property, will AI impact the tenants to the point where they won't be a tenant in a few years because of AI? Or maybe in an office building, there'll be less space needed because AI will take more jobs. And therefore, that's a good example of where now that's one of the reasons why I'm concerned about office. Like, where's that demand for that office building going to be in 5 or 10 years from now that could be impacted by AI? And that's why one of the reasons why office is kind of a tier B for me in terms of predictability and not the tier A of apartments and mobile home parks we talked about. Okay, so I would think about it that way from an investor perspective. As far as the economy goes, and we can get into that, I know we only have like 4 minutes, but my personal opinion is for many different reasons due to many indicators. I think there's a very high probability of a recession. I think there's a very high probability of a 30 to 50% stock market correction. And I think that will cause a lot of challenges in the space, which will be very positive for people who are sitting patiently on the sidelines like me, waiting until prices adjust more. It'll be not great for someone who's already in opportunities necessarily, depending on what you're in. So I do think that the economy is in for a recession. I do think the stock market has a high probability of having a pretty bad crash. And I think that will actually impact investor sentiment. That will also reduce lending, which will make it harder to purchase opportunities. And all that equates to the fact that I think prices will be lower and there'll be a better time to invest coming up for investors, which is why I'm mostly on the sidelines very, very tightly right now.
I love this question. SS is asking, how much time do you spend per week vetting your investments or analyzing them?
Yeah, great question. I actually spent a lot more time, which we didn't really get to, analyzing the economy than the investments. Because the investments, most of them I can weed out within 2 minutes and say this isn't a fit. And especially at this particular timing when I'm on the sidelines, I'm pretty hell-bent unless it's something, I'm still investing, but it's got to be really, really unique. And for the reasons I just mentioned. The one thing that I think people under focus on as passive investors is the economy. Because in order for me to make the best decision possible when I'm looking at a 10-year timeline, I have to be able to think about where is the economy going to be in 5 or 10 years? What consumer trends are going to impact what type of real estate in 5 or 10 years, like AI? And does that make what I'm about to invest in less predictable? And is that not necessarily a good fit for my predictable cash flow I'm looking for? And so the economy to me is how I avoid the landmines. And the problem is that because you're illiquid and you're typically locked in for 5 or 10 years, you have to think way ahead. So I put the brakes on investing way before a recession. I mean, like 2 or 3 years before a recession. That's optimal. And then I sit and wait, which is very agonizing, but that's how you avoid the landmines. Because if not, you can't just wake up one day and say, oh, there may be a recession in 3 months. Oh, I shouldn't have made those investments a year or two ago, because now they're going to have a problem. No, you have to really think ahead. That's the tricky part, but you have to stay on top of the economy and the economic data to be able to do so.
All right. And in the last minute, we do have some people asking, and feel free to answer or not to answer. You mentioned that you have a group, but you like to keep it kind of private, not the public. Do you want to tell people how to join if they want to?
So in order to join, there's 3 requirements. You have to be an accredited investor. You have to have a call with me to learn about how it works. And you have to sign a mandatory waiver and consent agreement. That's very straightforward that I explained. So if you do want to join, you're welcome to contact me directly. And the easiest way to do that is just through my email, jroll, JROLL at Roll Investments, ROLL Investments with an S.com. So jroll at rollinvestments.com. I just want to warn everybody, though, that it's very low volume. just to give everybody an idea, because it's been very choppy times the last few years, I sent like 2 opportunities last year, the year before. I sent a 1 in 2019. Normally it's 3 or 5 when there's much more predictable, like smooth sailing times, but it's been a lot going on. So I am not a good resource for you guys to learn. And I'm not, honestly, because there's not enough opportunities you're going to see. And I'm also not a good resource for like a volume of opportunities to review. So it's important to understand that as well.
Do you want me to put your email address in the chat or not?
Yeah, you're welcome to. Yeah.
All right.
Just know also that I have a lot of travel going on in the next couple of months. So if you contact me, it might be a little bit before I can talk, but you're welcome to contact me.
All right. Hey, everybody. Can you take yourselves off of mute and thank Jeremy for coming in and speaking to the Alternative Investing Club today?
Thank you, Jeremy.
Thank you, Jeremy.
Very informative.
Jeremy.
Thank
you.
Thank you very much.
Thanks a lot.
Have a great week and bye.
Thank you, guys.
Hey, Daniel.
Jeremy.
Yeah.
Hey, so I've been very ill, so I haven't been on these meetings.
Does this relate to the meeting here, or should we talk afterwards?
I guess it's all the meetings in general, but maybe I can
Okay.
probably just talk afterwards, or maybe email you. It was about the recordings and what Intel is doing with like the portal and all that stuff. But yeah.
Oh, so we have a YouTube channel. All the recordings are over there now. Go search for Alternative Investing Club.
Oh, okay, cool.
Jeremy, thank you so much for coming, and really great. You know, this in the past, people have said that they always want to see a presentation and not have the fireside chat thing, but this worked out really well, and I tend to enjoy the fireside chats. So thank you for coming and speaking with us.
No problem. Honestly, I like the concept of Q&A as long as there's enough questions, of course. But to me, that way people's questions get answered. So I'm a big fan of it. Even at conference when I'm on a panel, they usually don't have enough time for Q&A, in my opinion. So I'm happy. Hopefully, this is helpful for people. So
could we? Could I ask one thing to Jeremy? Is it possible in the future to come back and maybe do one of those presentations with like, I don't know, like maybe I thought like however you, I don't know, give a full presentation. I'm just asking because this was it's actually refreshing to meet somebody that's not about sales pitches and has this low risk way of going about things.
Are you looking for him to like evaluate a deal, or
no,
come back and have another fireside chat?
Yeah, something like that, or like kind of like a step by step, or sort of how he's gone about things. Yeah, like a sort of like my journey in passive. Yeah, so, something like that. Yeah. More like a fireside chat with maybe like presentation, like more what's the word? I suppose structured. I guess I don't know. Does that make sense?
Yeah. Well, let me just say, I try to put a little space between returning speakers, like 6 months usually. But of course, Jeremy, you're welcome back whenever you want. Yeah.
And I will say too that I thank Daniel for doing the fireside chat, because one of the challenges I have is I don't have a presentation because I'm just an investor. And so I usually push, totally honestly, I usually push back on creating a presentation because it takes me like hours and I'm never going to use it again, And so I'm happy to do the fireside chat, and maybe what will be helpful is that if you had any specific questions in advance or wanted to structure a certain way where we discuss certain topics, that's also a possibility where there's not a presentation, but it's more structured, whatever you guys want.
All right, everybody, thank you so much for being here, and we will see you next week with another fabulous investors talk. Talk to you later. Bye.
Thank you, Daniel.
Thank you.